Welcome to This Explainer. Today, we're unpacking one of the most irresistible, intoxicating things in the entire stock market, the massive double-digit dividend yield. I mean, let's be honest, there's a certain type of number out there that just gets income investors fired up almost instantly, right? First, you see a 10% yield, then maybe a 15, then 20, and then suddenly you spot a yield sitting right around that extraordinary 30% mark. The math in your head happens automatically, and it seems almost too easy. You drop 10 grand into a stock yielding 20 or 30%, and bam, it looks like you've just unlocked an easy $2,000 or $3,000 a year in purely passive income. It literally sounds like a dream. But hold on a second. Here's the critical question we almost always forget to ask ourselves in the heat of the moment. Why on earth would the market pay you 20% just to own a stock? Today, we really need to put aside that temptation to just blindly chase yield. We're going to start thinking like forensic investigators, because while sometimes a huge dividend is a genuine opportunity, very often it's actually a blaring red alert warning sign. The harsh reality is, the biggest yield might just be the one you should fear the most. In this explainer, we are going to ruthlessly interrogate 10 high-yielding U.S.-listed income securities. But we aren't here to rank them by their payout. Oh no. We're going to uncover the hidden risks lurking behind completely different business models to figure out if that income is actually truly being earned. So let's lay down some ground rules for our financial forensics investigation. We're simply going to follow the money. We check the dividend, the earnings, the losses, the balance sheet, and finally, the net asset value, or NAV. We have to look underneath the headline yield. All right, let's jump into case study 1, the coverage trap. Let's bring in our first suspect, Oxford Square Capital, ticker OXSQ. It's a business development company holding bank loans. And lately, high dividend screens have been flashing this stock with an annualized yield up around that crazy 30% area. But check out this glaring, totally uncomfortable gap. In their second quarter, they generated roughly 5 cents of net investment income per share, but their declared distributions, those add up to about 10.5 cents. Do the math. They're paying out more than double what they're actually generating in recurring investment income. That headline yield is just an illusion. You literally cannot analyze it without looking underneath the hood. And honestly, the underlying deterioration is way more concerning. Their NAV per share actually dropped during Q2. They reported $5.2 million in realized losses, which completely wiped out their unrealized depreciation. They even have a $6.9 million preferred equity investment just sitting there on non-accrual status, which is finance speak for it's not paying. So the vital question isn't why the yield is 30%. The real question is what happens to this so-called income machine when the asset value just keeps dropping and those losses keep mounting. Moving right along to case study 2, the NAV illusion. This is where things get tricky. Let's look at FSKKR Capital, or FSK. On the surface, their 44-cent distribution is 100% covered by their 44 cents of net investment income. Management has even been repurchasing shares below NAV, and they actually improved their leverage, dropping it from 138% down to 127%. Sounds fantastic, right? Well, wait a minute. Their NAV actually declined by 2.8%. They reported a standard GAAP earnings loss of 13 cents per share and total investment losses of 56 cents per share. It's a really confusing puzzle for investors. Can a stock actually be attractive when the dividend is fully covered, but the underlying asset itself is losing value? Now, contrast that with OFS Capital's second quarter dilemma. They have the exact opposite problem. On one side, their NAV actually increased thanks to a temporary 34-cent per share net gain on investments. But then you look at the other side, and their net investment income completely collapsed by 56%. It dropped to just 8 cents a share, all while they stubbornly maintained a 17-cent distribution. This is a massive takeaway for us. You can never, ever confuse a temporary investment gain with recurring sustainable cash generation. Which perfectly tees up Prospect Capital, or PSEC. This right here illustrates the absolute ultimate dividend trap. Sure, you've got income in one pocket. Their 15 cents of net investment income comfortably covers their 11.5-cent distribution. Great. But check the other pocket. Massive capital loss. Their NAV fell roughly 13% year over year. Look, a covered dividend means absolutely nothing if you're simultaneously suffering severe double-digit capital value destruction. Next up, case study 3, hidden leverage and structural risks. Let's pull up BlackRock TCP Capital, TCPC. Yes, their recurring income covers their 17-cent dividend. But the real story here is this dramatic balance sheet transformation they're going through. They are targeting a massive drop in net leverage, taking it from roughly 1.38 times all the way down to around zero point 0.3 or zero point 0.4 times. How are they doing that? By executing a staggering $523 million portfolio sale. So the question we have to ask is, does slashing net leverage through a massive portfolio sale actually make their dividends safer, even if they're accepting a much smaller investment portfolio to generate that cash? And the specific sector you're playing in matters heavily here, so let's rapid fire through 4 totally unique traps. With NextPoint Real Estate Finance, NREF, their coverage metrics vary wildly depending on which accounting measure you use, which just proves you always have to ask, covered by what exactly? Then there's Scion. Their dividend is covered, sure, but as a credit business, macro default risks are looming pretty large right now. Armor Residential REIT, ARR, flashes a 16% plus yield, but it is hypersensitive to interest rates and mortgage spreads. And finally, Triple Point Venture Growth, TPVG. They rely on venture-backed businesses, which exposes you to major cash burn and valuation compression if private funding suddenly dries up. Oh, and we can't forget Great Elm Capital, GECC. This is a classic textbook example of what happens when a stock trades at a deep, deep discount to its net asset value. At the current market price, the yield is an eye-popping 18%, but if you calculate it based on its actual NAV, it's only 12.9%. The market is literally screaming a warning at us here. It's effectively saying, hey, we do not value $1 of this company's assets at $1. So how do we grade all this? Let's check out the investigator's scorecard. Consider this your ultimate detective's toolkit. Here are the 5 essential tests that separate sophisticated income analysts from naive yield chasers. Test 1. Is the dividend actually covered by recurring NII? Like we saw when we questioned OSSQ. Test 2. Is the NAV growing, or is it steadily shrinking like we saw with FSK? Test 3. Is leverage getting better or worse? Think of TCPC's massive restructuring. Test 4. Are realized losses and non-accruals becoming a dangerous trend? And finally, Test 5. What happens to these underlying assets if we hit a recession and credit losses suddenly spike? Which brings us to the moment of truth, the final verdict. All right, here's how these 10 stocks stack up based on their true underlying business health. Looking at the buy and accumulate and watch categories. FSK, TCPC, and CION definitely require your own due diligence, but they show fundamental promise. Their dividends are covered by NII, and management is actively improving their balance sheets. Meanwhile, NRF, GECC, and TPVG fall firmly into the watch category. They offer some pretty interesting opportunities, but they require very close monitoring because of those mixed coverage metrics, steep NAV discounts, or highly unpredictable sector risks we just talked about. But now, let's step into the danger zone. We are explicitly warning conservative investors to completely avoid PSEC. That relentless year-over-year capital destruction is just too much, and we absolutely have to classify OSSQ, OFS, and ARR as highly speculative. OSSQ's 30% yield is just masking a massive income shortfall. OFS is dealing with collapsing recurring income, and ARR is way too sensitive to shifting financing conditions. And this all leads us to a really harsh mathematical truth that every single investor needs to take away from this. Listen closely. A 20% dividend doesn't actually mean you're earning 20%. A giant distribution means absolutely zero if the underlying asset decay just wipes out your principal. If you collect $2,000 in income, but the stock itself loses $2,500 in value, you suffered a net loss. End of story. Often, the highest yield on the board is simply the market's way of telling you to look closer. So the big paradigm shift I want you to walk away with today is this. You are not buying a dividend. You're investing in an income business. Think about it. If you had $10,000 to deploy right now, would you rather chase some empty, flashy percentage, or would you seek out a rock-solid, sustainable balance sheet that actually protects your capital? Just a quick reminder before we wrap up. Our classifications today are purely for educational research, not personalized financial advice. As we've seen, high-yield securities can and do experience substantial price declines and losses of principal. So I leave you with this final thought. When you open up your brokerage app and look at your own portfolio today, are you actually building a sustainable income engine, or are you just sitting on a trap waiting to spring? Always do your own due diligence, and I'll see you in the next explainer.